Welcome to our capital allocation briefing, both those here in our Melbourne headquarters and those joining us via webcast. I'm Peter Bevan, BHP's Chief Financial Officer. Most of you will be familiar with our capital allocation framework. Today, we want to take you through the comprehensive processes that sit behind this simple framework and aim to demonstrate the improvement and mindset changes that have been institutionalized across BHP. Through a better understanding of our approach, we hope to become more transparent and more predictable as we look to drive increased value and returns. And as always, please note the disclaimer. So our key purpose is to create long-term shareholder value. We seek to achieve this by having the best commodities, the best assets, and world-class culture and capabilities. I think this is and will continue to be a simple and winning formula in this industry. And key enablers to this are a strong balance sheet and the right capital allocation process. Over the last cycle, we learned, sometimes the hard way, that to become better allocators of capital, we have to ensure our portfolio remains resilient over the long term, particularly in a rapidly changing world, by greater use of divergent scenarios. We need to deal better with near-term volatility by thinking in ranges rather than point estimates or mid-cases. We need to better incorporate risk, both downside and upside, as well as reward into all investment decisions. And we have to build and maintain financial flexibility to enable counter-cyclical investing. So to achieve this, we've embedded a capital allocation framework that strikes a balance between shareholder returns, investment, and our balance sheet. Improved our portfolio and project evaluation capability to test the resilience and enable more robust competition for capital, and made structural changes throughout the organization to improve governance, objectivity, and expertise. It's fine to have a better framework or better evaluation processes. The acid test is whether we're making better decisions. We think we are, and our track record of recent years shows this. These decisions, along with productivity and, of course, better prices, are supporting continued improvement in value and returns. And so we don't have all the answers on capital allocation. We continue to learn and improve. And in fact, today is part of that improvement loop. We welcome your views, both here and in the future. The mining industry is both capital intensive and highly cyclical, with long lead times, payback periods, and volatile cash flows. And over the long term, capital allocation is perhaps the key driver and differentiator of company performance. Across the industry and within BHP, there have been periods of good capital allocation and periods of poor capital allocation. Over the long term, resource companies' returns have been competitive with other industries. But this hides the industry's pro-cyclical tendencies over the shorter term. Typically, we've seen management teams invest more capital at the top of the cycle, chasing growth, and less at the bottom as the focus shifts to debt reduction. And sometimes this has been driven by misreading the cycle, investor pressure, which we all know can also be pro-cyclical, or over-exuberance. But it often comes at the shareholders' expense, and certainly we've played our part. The result is that trust has been dented, and the industry's license to invest curtailed. There's no question this has created healthy discipline. This is good for cash flows and yield metrics. Again, no question. But a narrow focus on cash returns can come at the expense of investment. The investment that can grow medium and longer term value and dividends. So one more time, let me reiterate, discipline around good investment decision has been and always will be a vital value creation differentiator. But the risk is we confuse no investing with good investing. So on one hand, we know that over-investing destroys value, but that under-investing, likewise, can also destroy value. So we have to find a balance. And for us, the key to having confidence in our ability to find and manage that balance is the capital allocation process. Everything has to start with a strategy. Capital allocation plays a key role in the execution of our strategic framework. That's centered around large commodities with high economic rent and growth potential, large, low-cost, expandable assets which deliver rent and growth potential through the cycle, and world-class capabilities with a culture that empowers and engages our people. Our industry is volatile, and asset prices follow this volatility. So while this can be a major value risk, this volatility also creates value opportunities. So we must invest in the right commodities and the right assets, but critically at the right time. Countercyclical investing is when value creation is maximized. To invest countercyclically, we must own or have control of access to embedded options, so we can execute at the timing that we choose. That's one. Two, we must have the capability and financial firepower to deliver those projects at that right point in the cycle. We seek a strong balance sheet at the bottom of the cycle. And we must have the support and the trust of our shareholders. No countercyclical investment is easy. Almost by definition, you're running against consensus. So, 1, 2, 3. Our balance sheet strategy takes into account two standout characteristics of the resource industry: the volatility and the capital intensity. At the bottom of the cycle, the balance sheet enables both defense and offense. The defense aspect ensures that there is a buffer against lower prices and cash flows. Our balance sheet can never become the strategy. We've seen some occurrences of that in the last major downturn. Capital has to be available to allow the right investments in the right projects, and that obviously is the offense. And throughout the cycle, it must be efficient from an ROE perspective. A low cost of capital is a key competitive advantage. An efficient balance sheet delivers an optimum return on equity outcome, which is ultimately what we're here for. Over the past 5 years, we've worked hard to learn from our mistakes. We've made significant improvements. We've institutionalized our approach to capital allocation. We've reduced net debt by $15 billion. We've changed our dividend policy to a more appropriate payout ratio basis. We've introduced a transparent framework, net debt target range, multi-year CapEx guidance, and significantly improved returns to shareholders. We've increased our capability to make resilient and disciplined decisions by driving project innovation and capital productivity to improve project economics, stress-tested using scenarios, ranges, and shock events, and better evaluated quantitative and qualitative risks and returns. We've reorganized our structure to be more objective. For example, in the creation of investment options, where organic project creation and promotion sit with the assets, and M&A ideas sit with the portfolio and strategy development team, the business development folks, if you like. Importantly, we maintain a hand-in-glove working relationship between the finance functions and the assets. This objectivity extends to analysis and decision-making, where we've separated project analysis and, again, project promotion. Capital prioritization is done centrally by our portfolio and strategy team, market analysis and price forecasting by marketing and strategy teams, and we have standardized governance and feedback loops for continuous improvements, including the board. Now, all of those things, of course, happen. You say the central accountability for these things sits, say, with finance for capital prioritization, but of course we are working at all times hand in glove with the assets and the regional presidents. We will make those decisions essentially together. So let me give you more detail in each of these areas. You'll have all seen our capital allocation framework before. We introduced it almost 3 years ago, following the change in dividend policy at the bottom of the last cycle. With the removal of the progressive dividend and added flexibility this provided, we thought it crucial to transparently show how capital would be allocated and then hold ourselves accountable at every reporting period as to how we did against that. The simplicity of this diagram masks the comprehensive thinking that sits behind it. And let me remind you very quickly of the high-level priorities of our capital. First priority, maintain safe and reliable operations. Then we test a broad range of internal metrics to confirm our balance sheet is strong through the cycle. And once we've satisfied these requirements, we pay a minimum dividend of 50% of earnings in cash. And if there's surplus capital beyond this, further shareholder returns through dividend or buyback, further strengthen the balance sheet, and organic or inorganic development options, and all compete equally for capital. The output of this process is, looking forward, a net debt range of $10 to $15 billion, annual capex guidance under $8 billion, at least until the end of the 2020 financial year, and a commitment to return surplus cash to shareholders in excess of the minimum dividend. And obviously you just saw that with the shale proceeds going back in their entirety. We think this framework resists pro-cyclicality and gives us the required flexibility and optionality needed to grow value and returns through the cycle. As I said, we've moved accountabilities for who does what, but importantly, we also now take a more integrated approach to capital allocation across the assets and the finance and marketing functions. Our process starts with fundamental long-term market and scenario analysis. And through this lens, we assess our existing portfolio and its resilience. Our asset and business development teams create options for the future. Our investment evaluation team, there's a finance team, assesses these options using standardized evaluation techniques, and we feed those into our capital prioritization process. And throughout, we continue to assess the strength of our balance sheet and test all investments against further returns to shareholders. However, investment decisions are only good as the information they're based on, so those underlying assumptions are absolutely vital. And we think we've also improved our capability here. Our marketing team identified factors contributing to pro-cyclicality in our assumptions, and we now apply more rigorous fundamental analysis. With more consistent and stable long-term views, we test the resilience of each project and portfolio through a range of metrics, as shown here. Most investment decisions are not black and white, and judgment can never be removed from investment decisions. We appreciate that projects may look very investable under some metrics, but uninvestable under others. And shale taught us a lot of lessons. So with initial high recoveries, our shale business had fast paybacks. So the midpoint IRRs say invest aggressively. However, a more holistic look shows something different. It takes a lot of capital to produce the NPVs. So when you look at the value as a proportion of the investment dollars, the capital efficiency ratio, it's much weaker. Crucially, the all-in cost is high. So free cash flow margins, as opposed to operating margins, are thin. And optionality, in other words, the ability to continue to invest and expand, and in fact, the resource life, part of the optionality, is also low. So you have one shot at making money. If the near-term cycle goes against your expectations, you can easily lose value. So in fact, shale is a tricky value proposition. It is possible to make value for shareholders, but the risks are high given the volatility of outcomes. So either you apply a much higher return threshold or you actively manage volatility by hedging. And that, of course, comes with added cost and complexity. So we learned that it's critical to apply a range of measures for both risk and return. We have to actively manage risk like we manage return, and we must think through the full range of outcomes. And we know that one size absolutely does not fit all. Staring mechanistically at midpoint IRRs, or hurdle rates, in another language, can be a major trap. This slide tries to show some of the risk-return characteristics of our project options. So this is continuing to build on what we just spoke about, what we learned from shale. We have high-return, low-risk projects that are generally in the brownfields categories. This is the top right quadrant. So while they tend to have low optionality, they also have high capital efficiency and high returns. And so no surprise, we like these sort of projects. The other side of the coin is the low return, higher risk projects. This quadrant contains shale, for the reasons I just went through, and also some of the projects we've shelved, such as the Wayo Outer Harbour and the Olympic Dam open cut. Those projects sought to capture all the optionality in one go. So that would, I suppose, maximize the NPV. But on the other hand, it required very high capex relative to the returns, and obviously long paybacks. And they also had the additional issue of the likelihood of large commodity market impacts because they were large projects, seeking to capture all the optionality in one go. So I think, for me, relatively easier calls in these two quadrants, the top right, the bottom left. The first to invest, obviously, the second not to invest. The other two are a little trickier. Top left quadrant has high return, high optionality, but high risk projects, the Trions, the Ecuadors, and so on of the world. We could lose all our investment on these, for instance, if exploration fails. But we could also create the tier one assets of the future. So we do invest, but we do so judiciously at an early stage. We look ideally for a way to understand risk as we generate more information. And we like to have lots of go, no-go decision points before we commit really big capital. Classic option thinking. And we want a portfolio of these as we need to ensure that the long-term value growth of the company is taken care of. Not all of them will come off. Some will fail. But we will not have bet the farm on any one individual option. So the final quadrant, the bottom right, is perhaps the most interesting. These are the projects that are typically greenfields, such as Scarborough and Jansen. It's worth mentioning that most of our current assets, of course, started life in that quadrant. They require large upfront investment, which creates longer paybacks and therefore lower IRRs. It's mathematical. And larger scale to ensure capital efficiency per ton of productive capacity. You have to have a certain amount of tons in a greenfield, otherwise your dollars per ton blows out. That means the impact on the underlying commodity market, again, as we saw in this, and as I mentioned in the bottom left quadrant, also needs to be carefully considered. So on the other hand, given the quality of the resource bases we insist on, the operating costs will be low. And combined with the rent available in the commodities, again, which we deliberately choose, the margins will be high. And given their long life, these projects will produce excellent margins and cash flows through many cycles, making the returns resilient to market volatility. And these characteristics give a high probability of at least getting the value of your invested capital back, even in low price scenarios. And that's why we classify them as lower risk. Most have lots of embedded optionality for future growth, with capital efficient expansions and ongoing low costs. And these, of course, are the source of the highly attractive brownfield projects that we all love in that top right-hand corner. Jansen is an example of this. It has attractive aspects because it's likely to be the lowest cost producer in the world. $100 FOB Vancouver. It's got a multi-decade resource base, as we all know. And the existing shafts will allow up to 3 subsequent capital-efficient brownfields expansions. But it also has the large initial capex and slower payback and possible impact on the market features that need us to be very thoughtful and cautious. And as I said a moment ago, this quadrant does not always allow for easy decisions. So we continue to work this project to improve its risk-return characteristics. We aspire to grow value for shareholders in terms of NPV and future cash returns. And I strongly believe that a world-class resources company should have a portfolio of all these types of options shown in these slides. An unbalanced portfolio overweight with long-term options will penalize near to medium-term returns to shareholders. And obviously on the other side of that, while a portfolio with only near-term low-risk options will jeopardize long-term value and dividend growth. Of course, we always test the investment in these options against a buyback or additional dividend to maintain capital discipline. This is the benchmark against all investments that all investments have to measure against. There's no difference between how we analyze a cash return to shareholders in whatever form as to how we analyze a project on a risk-adjusted basis. Okay, so much for the theory. So what have we actually done? Since the inception of the capital allocation framework, we've rebalanced our use of capital. This balance is illustrated here. We've continued to invest in high-return development options, benefited by improved capital efficiency. We've also added high-return, high-risk options in copper and oil. We've continued to work the large project portfolios such as Scarborough and Jansen to make them more investable. And we've exited the low-return, higher-risk assets such as shale. And we've made ROCE a central tenet of all of our decision-making. And at the same time, we've steadily increased the proportion of free cash flow distributed to shareholders, most recently with our announced distribution of the onshore US proceeds. And notably, this has been achieved at a time when we've also significantly reduced net debt. The optimal balance between shareholder returns, investment for value, and balance sheet will naturally evolve through the cycle. Future capital decisions will continue to be determined by our capital allocation framework, and our focus on shareholder returns, of course, will never waver. So again, more on the track record. We've restored the strength of our balance sheet. We've actioned 5 highly capital efficient latent capacity projects. We've sanctioned 3 major projects with an average IRR, that single measure, but in any event, of 20%. These are good projects. We've expanded our exploration and development portfolio through acquisitions in prospective copper and conventional oil options. We've dramatically simplified our portfolio, notably with the divestment of US onshore and, of course, the South 32 demerger. And most importantly, we announced the return of almost $23 billion to shareholders. The changes we've made, we think, are delivering results. Helped by higher commodity prices and the productivity gains, we're expecting to increase returns from 2.4% 3 years ago, to 19% this year, and at the same time improve base value. And this has been achieved through the disciplined allocation of capital towards the productivity improvements, high returning latent capacity projects, and the delivery of major growth projects. And future performance will extend our track record. We will maintain net debt at the lower end of our target range in the current price environment. We will maintain capital expenditure and exploration below $8 billion per annum out to 2020, and we will execute the competitive options we have recently sanctioned: Mad Dog Phase 2, Spence Growth Option, and South Flank. And we will continue to develop our balanced suite of brownfields, greenfields, and exploration options. Consistent with our capital allocation framework, we expect to increase the proportion of future cash flow, free cash flow, to be returned to shareholders. Our strategy is built on exposure to highly attractive commodities, world-class assets, and leading culture and capabilities. Our strong balance sheet and enhanced capital allocation process are key enablers of this strategy, and supported by a reshaped organizational structure and robust approach to evaluation. So going forward enables us to see inevitable volatility as an opportunity rather than a threat, through greater conviction in the future, balance sheet strength, and the ability to invest through the cycle, a deep suite of options that we own across commodities and time periods, a relentless focus on capital productivity and competition for capital, and a better appreciation of risk as well as return. And these changes are structural. They've been embedded, and they are driving better decisions. And decisions that have and will continue to deliver increased value and higher returns. So with that, we'll open it to some questions, which either I or my colleagues will take. I think we've got a microphone. We're just going to have to just a couple of those roving microphones.
Do you think you've got enough project options? So when I look at the list of projects towards the back of the presentation, I guess it doesn't take long to get to Jansen, which I guess a lot of us don't think will go ahead. So therefore, you've only got you can probably count them on one hand. In terms of those projects competing aggressively for capital, I guess there's not a lot of them and there's a lot of capital. So what do you do to try and get more projects into the portfolio?
Let me think. Let me know where to start. First of all, let's say I suppose you'd probably never have somebody stand up and say, "Oh, we got too many options or enough," and so on. Having said that, I think we have got a good range of options. We would like, as we've said, more options in copper and oil because one, those are growing commodities and they need more options invested in, and we think we can make. There's good rent available. We think that we have more than enough options in our bulks in the event that the market needs that, and it may well not. So we're pretty cautious about that. But nevertheless, our resource bases are, amongst the best in the world and are absolutely expandable. So I'd say that I would agree with the premise that we would like to have more. I do, however, say I think, and as we've tried to show a number of times, that we do have, I think, a very good growth portfolio, balanced of those near term, the medium, and the long term. We can talk about potash in more detail, no doubt, today and future months. Look, the other thing I'd say, in the event that none of these things come off, because we haven't approved a whole ton of these things, right? That means we'll make a lot of cash, and we'll give those back to shareholders. And that's exactly how the capital allocation framework works. That's just fine. There's no issue with that. That's going to be good value for shareholders. We're not frightened of that.
It's Hayden Besto from Macquarie. Just interested on you working some of these sort of lower return projects up like Jansen over time to try and make them better. How does that flow through when you're not the operator like Scarborough or Resolution where your JV partner may have a different hurdle?
Yeah, no, I think Scarborough is a very interesting example of that. So as you know, we had this thing since 1979 and it was kind of stuck, right? And so what we thought about is that we needed to find a way to create better alignment of interest, economic interests. And so we sold down, as you know, to Woodside. And we obviously try to get value out of that sell down, but what we also wanted to do was get greater unitization. And as a result of which, I think it's sort of more or less worked out. Exxon exited, Woodies came in. We sought and gained a further 10% option on that. And so there is an example of I think, there is more. The important thing is that in terms of trying to create value, some of it is as simple as making sure that it's investable, but actually getting it executed. And so there is more to the value creation per project than meets simply, okay, we're going to have a better, a lower capex or something like that. So, I'd say that, again, I think our track record is reasonable on that at this point in time. We're pretty happy with that.
Hi, Pete. Paul Young from Goldman Sachs. Pete, at the peak, you were spending $2 billion a month, I think, on capital, had a dozen projects or so on the go. At the moment, you've got 4 major projects on the go, if I actually include Olympic Dam as a goer, which I think most people assume is, and you're spending up to $8 billion. Have you... This presentation, it's great. I'm just trying to get a sense of your project execution abilities under current management, and have you thought about the maximum amount of projects that you can develop at once without to avoid capital blowouts and project delays? That's the first question. The other one, I want just to probably, I guess, a pet subject of mine is hurdle rates, and we've had many discussions in the past on this. And I think you said it's IRRs are sort of one-dimensional, but I just want to marry that up with the fact that you said that you always return on capital employed is at the centre of your decision making. So is it more a fact that you might have Jansen at 13% IRR, another project 23%, so it's a blended return you're looking at and also maximising value? Just want to explore the hurdle rate debate again, thanks.
Yeah, actually, I might ask Matt to answer the first, and then maybe just before, so I don't forget your question, I'll go at yours. I sort of thought that hurdle rate question would be a little controversial. Look, we're not saying that hurdle rates aren't useful and so on. In fact, we use hurdle rates as a kind of a blunt instrument sometimes internally. But when it comes to an investment, we don't smudge things together and say, okay, here's one that's I don't know, 11 and this one's 23. So if you add them up together, it's fine. Every project has to stand on its own. It also has to stand up more or less on its own by the current incarnation of this thing. So this is so we spoke about embedded optionality. Critical, important. We must take the value of that into account. But I think if we make a decision to say, okay, we're going to invest in something and it's going to work out because of the second and the third and the fourth iteration of this thing, once you get it in, once you spend the sort of the flagfall concept, we don't love that. So I think that's really where it is at. I think, going back to the hurdle rate, here's the thing. So Paul, it is what we're trying to say is what we've learned, which is that and shale was just a perfect example of that. If you just look at one thing, you will invest, what did we invest? $40 billion. Because the IRR will say do this, and it isn't the right answer. Sometimes it is, and it is the right metric, and sometimes it isn't. So we try and take a more holistic view on that. But the hurdle rate, I don't think it's by the simplicity and the discipline that creates. We do use that, as I say, just not when you come to make a really big decision as a single point. Matt, you want to have a crack?
Yeah, sure. Project capability is not a single-shot solution. The market does change quite dramatically, as we've seen over the last 5 or 6 years. In our numbers, we're down to probably a quarter or a third of what we had here in Australia. So we're now setting execution strategies at the time for when we're going through the final study phase and into execution. We're using the EPCM model a lot less, but it doesn't mean that it's off the table if we needed additional capability. An example would be South Flank, where as a one-off major project in WA, where we'd finished the portfolio and we were ramping back up, we felt we couldn't build up that team solely ourselves. So we set up an integrated project team, brought Fleur in as our partner. We're working in a 2-tier model for the efficiency dimensions. So we're chasing that whole lower capital solution by bringing 2-tier, not 3. That doesn't mean that we're going to run an integrated project team at OD for BFX. We'll still assess the risks and the capabilities we need and how the market can service them at the time.
So I'd say at this point in time, I don't think we're seeing, we want to have a more balanced portfolio across the commodities, across the regions. And so at this point in time, we're not running into that constraint. But no question, if we ever went back to that, or not that we will ever go back to that world, unquestionably, then of course we would take that into account. But we're a mile off that, I think, at the moment. Yeah.
Clark Wilkins from Citi.
Hey, Clark.
You mentioned earlier about the investment decisions being measured against returns to shareholders and buybacks. Can you just sort of quantify, like the quantification of that process? So how are you measuring, the returns to shareholders versus, these investment decisions and weighing up that option?
Sure. So we just had this in spades, obviously, as we just made this decision and on the buyback and so on. So, and again, it's not very hard to conceptualize this. If you're buying BHP, then of course you're buying a stream of cash flows. We know what those things are. We know what they look like through the ranges. We know what the probabilistics of those are, because everything is done on probabilistics. And we know what we have to pay for it, because you can look on the screen, plus minus 14%, whatever, or PLC or limited. And so the result of which you can calculate IRRs, NPVs, capital efficiency ratios, all our risk metrics, and we just put that onto the same. All of our projects go on various measures of risk and return and they compete against each other. And what you get is a sort of a creaming curve of of capital efficiency between risk and return. Some projects, as we just try to explain, have higher returns, higher risk, and so on. And so you can't say, okay, you can't draw a bright line either way and say it is a creaming curve, if you like. And the buyback, further return to shareholders, looks exactly like that. The smart, of course, you're smart enough to figure out that actually you can get, hypothetically, a situation where, in fact, the share price is so high that, I'm saying hypothetically, is so high, in fact, that you can destroy value by buying back shares. That's, of course, something which you have to be extremely thoughtful about. And so if that was ever the case, if we ever thought that, then of course the next relative measure, of course, is your weighted average cost of capital. So it's either the higher of the buyback, the return on a buyback, or weighted cost of capital. And of course, all projects, standalone projects, have their own risk portfolio. So, and it's not, BHP is obviously a portfolio, it has much lower risk characteristics versus a single project. So those things all have to compete, not on an equal basis, but they have to be much better than a buyback because they have individually higher risk. I think we got one at the back.
Hey Peter, this is Jade from UBS.
Hey, Jade.
You mentioned before that investment decisions are as good as your assumptions that you
Sure.
put in. We know that commodity price forecast drives a lot of investment decisions. I wanted to understand in a little bit more detail around how you've built the capabilities up in this price forecasting area.
Want to have a crack? Something between Paul and Hugh.
Okay, so
Can I just say, before you start, just one thing. I just want to keep coming back to this because it's really important. It's one of the things we learned, is that you have to separate promotion from the evaluation and from the folks who do the assumptions. Otherwise, you put that all into a box, in the same box, you can get some slightly unusual outcomes, or not ideal outcomes. So,
well, the first way to improve your forecasting is to take a very realistic and scientific view of what you've done in the past. We've learnt from where mistakes have been made, and we've actively taken steps to improve where we've identified either methodological or human factors which introduce bias into our historical process. And we've been moving decisively along that front over the last 3 years or so. I think that we've become more technically proficient. We've invested in areas that matter the most in terms of tackling big uncertainties. And we've introduced new methods to get away from mid-cases, to stress test critical assumptions, bottom-up, reverse stress tested, high-level scenario framing for everything that we do. And this operates on multiple time horizons, whether what Vandita's talking about for her balance sheet or what Paul is talking about for his very long-term strategy and portfolio construction. And I'll be talking about this all afternoon.
can I say, Jay, I think there's two parts of this thing that have to work. First of all, we have to have better assumptions. But the second part is just maybe even more. So what do you use with those assumptions? So you say, okay, so in the past you say, okay, we didn't get, I don't know, the gas price right. You say, okay, it was whatever our midpoint assumption was. We're never going to get the midpoint right, ever. So the key thing is that we don't need to get the midpoint right, actually. What we need to get is the range more or less right, between high and low, and then put that into our models, and then see, on balance, across this range of metrics, how does this investment perform? This is really, really important. So you say, okay, at this point, we go into a conversation with ourselves, with the board, and you say, okay, this investment in the low looks like this. Hopefully, we get our money back in the low outcome. On the other hand, you put in, because there's more than one, okay, the critical assumption is always price, I guess, but the other big ones, resource, capex, whatever else, and you put those and you range those through until you get to the high side. You say, okay, what is the exposure to the high side? And so when we look at those two things, and then you try and be balanced about this thing. It's actually quite hard to be balanced, particularly I have to admit to you, because coming out of the scars and the trauma that we've been through, of course, all of our attention goes to what's going to happen in the downside. And yeah, we shouldn't forget that there is also an upside here, and that we have to balance those two things out. So that's just, a little bit of there's two parts of that actually, is how the methodology works, but also there's this judgment, this human judgment that's embedded in all of these things, and how we have to recognize our own biases at times, and so on. It's not easy.
Peter O'Connor from Shaw and Partners. I just want to think about the capital allocation process, but the existing portfolio.
Sure.
and start with a statement, if I could, that Ken and the board shouldn't give you another dollar until you make what you've got work.
Mm-hmm.
And with that in mind, just thinking about the portfolio and the ROCE, which is driven by capital turns and NOPAT margin, and picking on three examples, ODO, coal and iron ore.
Mm-hmm.
Coal has only really got there because of price, so NOPAT margin. We can debate whether that's the right price or not.
Okay.
Iron ore, great number in absolute terms and relative terms. Is it enough? Are you satisfied? And more importantly, ODO, put to you the concept of social welfare. Why would you put another dollar in there when there's $6 odd billion aren't making it or haven't ever made an acceptable return?
Okay.
So you focus a lot about where you're going to spend, but you're not telling me about what you've got and what you could do with it. So
Sure.
I think about $16
Great
billion
point.
of your capital base
You're
is
absolutely right.
underperforming.
I think that's a really great point. And we should have built that into the conversation. The first thing is look after your existing business, extract the most out of your existing business. So all projects start with this concept of optimize without. Optimize without what? The project. So before you come and ask for something, make sure that you show, and we demonstrate, and again, we'd be happy to talk about this in some detail, what it is that how this thing would look like without the money. And that's absolutely right. So, and also to the other part of your point, there, Rocky, is that, we must productivity, well, safety is the key driver, value of this organization, and productivity is the biggest value creator of the thing. It is. You're spot on. We've spoken about the capital allocation process because large amount of productivity doesn't require a large amount of capital. So happy days. But that I just want to really call out and agree with you. As for your comments about coal and so on, I think that's an interesting comment as well. Say okay, fine. So the price just came and rescued us, but that's what cyclicality is all about. So if we were to say, well, and we have a view on what those ranges are, and we have a view on how our assets will perform. So when coal was, thermal was 40 and met was 60, we had a view that it wasn't going to stay like that, and so we invested. And I know that, for instance, Cavill and so on, that took a pounding in the beginning, and I get it, but at the end of the day, they've kind of worked out, and I think that's fair. So I don't think I would agree with you on the first part of your thing, which is price comes to rescue you. Price is critical. We need to have a view on this thing, and it is cyclical. So yes and no. Fair challenge.
Peter, the stuff we're talking about on capital allocation strikes me as relating to sort of capital decisions in the sense of CapEx and exploration. But if we look at the history of BHP, by far the biggest sort of detractor from value has been M&A. And I assume we might be, I don't know what the rest of the day has in store for us, but are we going to have a discussion about M&A? Is that separate from this capital allocation framework?
Again,
yeah.
Great question. Again, no, it's not. Like we said, all investment opportunities, whether they're buybacks, which is a piece of M&A, just happens to be BHP, or our organic projects, or M&A and so on, all exactly in the same evaluation process, same folks, same assumptions, and so on and so on. I think that the interesting thing about M&A in this organization, there is, I would say, really simplistically characterize this, but ultimately we have more or less bought all our resource bases, the assets that you see today. If you really go back in time, obviously there are many developments since then. In petroleum, more or less, we found what we have today. So it does have of course, it has a part to play in the value creation of this an organization, and we have just, that's why we did Trion, we just did a little piece of SolGold. We still think it has a part to play. But again, what did I learn out of the things that we did badly? Well, first of all, make sure that you try and bid, like invest, bid, whatever, it's the same thing, at the right point in the cycle. That's pretty damn obvious. And that we didn't do that I'd say certainly for shale, and and I suppose Potash Corporation would have been in the same bucket if it had not been for other things, right? Second thing is, you go back, let's say, magma. Let's go to magma. Magma and shale, there's some similarities there. Magma was bought, I think, you remember, the copper price was $1.30. I remember this. It seemed like a very high number at the time, and it was a cyclical high. But more importantly, magma really was high cost. So you had that thin margin thing that I just spoke about in shale. So you bought at the top of the cycle, and there was a thin margin. And so, wham, we all know it, those of us have been around a little while, that cycle then went against, and the thing turned itself over. And inside a year, I don't know the details, but so those are the lessons you can learn. On the other hand, if you go and you buy Escondida, you buy Queensland Coal and so on, you buy a great resource base, you may not quite get the right point in the cycle, but you bought a great asset which will be resilient through the cycle. Why? Because it is low cost, because it is long life, and because it is expandable. So all of the lessons that we just put up there on that chart of the quadrants of the thing, I think are absolutely equally applicable to M&A. But M&A is harder because you have to pay the market price, and then you still have to get a return and so on. So I think that's why we don't really major on M&A as a fundamental driver. Certainly big ticket existing assets, it's as opposed to the sort of the early stage development assets.
Peter Linden from JP Morgan, just a quick follow-up. Can we, in your project assessment framework, can we explore the concept of market impact a little bit more? Sure. When I look at the projects that are going on, there's really not much in iron ore and coking coal, which are 2/3 of your earnings, other than depletion replacement, when we've got very attractive commodity prices. So clearly the business is either quite bearish on the outlook or is very worried about the market impact of bringing on volume in those areas of the business. So can we actually explore that bit, which didn't really get a whole lot of airtime?
I don't think it's very complicated, honestly. I mean, the reality is, we think that, the margins are we say, if we put more tons into the market which isn't growing, any commodity that isn't growing, basic principle, that's probably not the smartest thing we can do. So notwithstanding that we have all this embedded optionality in our met coal and iron ore business, I think we just should be, this is a classic example where you take a look at them, we keep them refreshed in the event that something happens. Either we have to be defensive because we have to protect ourselves, or in fact we have to be offensive because, I don't know, India takes off or whatever. But at the end of the day, the ROCE and the free cash flow of this organization depends on us doing smart things with the capital allocation there. Of course, the contrast of that in copper and in oil and, more controversially, obviously, potash is stark. Those commodities are growing. In fact, two of them have not only growth in demand, but in fact they have field decline or grade depletion. So, those two things combined say that there is need for additional investment. So we're happily putting and emphasizing our capital, both the longer term options as well as the medium and the shorter term options into those commodities. To Rocky's question, sorry, I will finish on this though. We should absolutely maximize the value of what we've invested in, swinging it back to coal, into, in fact, OD. You're absolutely right, Rocky. We need to do better on that thing, no doubt, and met coal. So that's why we continue to debottleneck those things, because it is not a big impact on the market, but it makes a ton of value, because we need to maximize what we've got. BFX is just a big version of that.
So just a follow-up to sort of joining your quadrant chart up with the question earlier about sort of buybacks, etc.
Sure.
Yeah, effectively, Jansen, you put as a low risk, low return. Buyback, you could argue, is even lower risk, and you could argue about the returns of things. So, how can a project like Jansen compete with buybacks unless there's something that dramatically changes in terms of the share price side?
Yeah, that's the thing about having a range of metrics. If you if you stare at just the risk metric, as in terms of, I don't know, say volatility of outcomes. Let's measure that, shall we? You say, okay, is BHP a lower volatility of returns measure? Yes. Than Jansen? Yes, absolutely. But there's more to it than that. You've got to pay for that stream of cash flows and that volatility. And you, collectively, the market, price BHP every day. And so, either you've completely mispriced it, which, you'd have your own views on, or you haven't. And so that's the sort of the little trick here, that you do have to look at the range of metrics of risk and return, and then you can take a balanced decision on this thing. None of this is easy. I wish it was. I wish it just all said, do all your capital in buybacks, do all your money in greenfields. It just doesn't work like that.
Peter, Andrew Hines from Evans Partners. One of the sort of phrases that's dropped off BHP's language through this new framework is sustaining capital. So how do you think about sustaining the business? And it's great to be paying extra dividends and buybacks, but if the cash flow that's generating those dividends is not sustainable, then obviously investors will require bigger and bigger yields over time. And if you look at your copper divisions, I think is a great example of this, where you've got declining grades, a lot of capital has gone into, if you look at sort of 2020, your copper output will be roughly what it was in 2010. $25 billion has been spent on that business over that decade. How do you think about sustaining the business and keeping production? Is that an objective or a thought process at all?
So we'd never go to a project to evaluate it in the investment committee or to the board and say, hey, you know what, we should invest in this thing because we need to keep our production rates up. That just that line would never be written. It would only be, does this thing make value or not? So we have invested in Escondido, I think correctly, in OGP1 and EWS and all the rest of it in order to maintain, offset that really very material grade decline. And I think that's been so whilst we haven't seen top line growth in the 1.2 million, we have maintained the 1.2, and I think that was a good value decision. And that's all there was to that decision. I think your other point, though, is that do we seek, have we, it's a little bit to the question earlier, which do we have enough options? Can we grow value? Of course we aspire to grow value and obviously the dividend that comes out of that. And do we have enough? We never have enough. And we're open, and on copper we would like to have some more. So that's why we are looking, our exploration program is active. We're okay with that, and have some options. And then, and of course, things like Cascabel and things like that. So yeah, it's, are we satisfied? No, absolutely not. By the way, the first part of your question, sustaining capital, first leg of the capital allocation framework says look after your business. And I think that's, I think more or less we're right on that. I think maybe there's some assets, Olympic Dam, probably we should have spent a little bit more on, but for the most part, as for the rest, fine. Okay, one more or two more.
William Morgan, Intrinsic Investment Management. Peter, there's only so much that staff can do.
Sure.
There's the frameworks internally and decision making and where you spend money. I'm thinking of fights that open an opportunity. For example, if there's wholesale industrial relations reform in Australia, then perhaps whole new options open up. If we got stable electricity grids for the long term, then it opens up whole new options for Olympic Dam. So just in terms of, I appreciate this is more about company thinking, but insights into board assessments of what fights to take on and what fights not to take on, and the balancing with social license to operate and the optionality that provides.
Okay, interesting question. I mean, we just had the ATO settlement yesterday. It's kind of a sort of an example of that, right? Look, these are just value equations. I mean, we will say Escondido was like this. At the end of the day, you take a look, and we have the same investment evaluation guys take a look at those decisions, and we run the ranges, and we try and we make assumptions, and then we try and make value decisions. Do we always get it right? Did we expect to have a 44-day strike last year at Escondido? No, not so much. So I accept that. But on the other hand, it sets up what happened this year. And I guess, we got a decent outcome, fair outcome, I'd say, in Queensland. So that's the sort of the way we think about this. ATO was an example again. So we cut a deal, right? There's a pragmatic discussion. We have our case. ATO has its case. We have strong points. They think they've got strong points. At the end of the day, you can go to court. You will spin this thing out for 5 years. So more or less, and it does come at some cost of sort of a reputational issue in the broader society here in Australia, for instance. And we do take that into account. But ultimately, that decision was made on value. And Paul was, so we have our tax team, we have our legal team, and we have Paul as integral part of that conversation because it's a value decision with Rod and Hall, his team, running all the numbers. It's kind of how it works. Big decisions, big money.
Peter, Tim Gerard from Janus Henderson. Just coming back to the buyback and the hypothetical case if the share price was at an extreme high level, and after all that can happen, the market will have a different short-term view. Copper's $4 a pound. You'll still be sticking to what you're sticking with, presumably, but the market will have a different view. How and a buyback won't presumably make sense in that kind of context. Have you thought about how you'd communicate to the market when you believe the stock is overvalued?
Yeah, that's right. That will be a problem. Yeah.
It could well be a problem, and I'd
No,
imagine you'd get a lot of brownie points for being honest about your view of the stock price.
Yep, I hear you. I mean, again, the buyback that we have currently underway, we know what the ranges are, where it stops working, where it does work, and so on. And so we've absolutely explicitly thought about that. That's clear cut in the board paper. We've had that conversation. We think that the value. Let me say that before I say anything more. Adrian's like, oh, please shut up. We think that the buyback makes sense. And if we ever got to the place that didn't, then of course we would cough it up. We have to. Yeah, absolutely.
Doesn't that just promote pro-cyclicality, though?
How so?
In the sense that if you assess everything versus a buyback, then implicitly your return hurdle is higher. But there was never a buyback when the shares were at $13, but there've been buybacks at $43, and now in the 30s.
Yeah, well, look, what can I say? First of all, it's not all about a buyback. It's a cash return to shareholders. So if your share price, Tim's point, if the share price happens to be cyclically very high, and we hypothetically don't see the value in it, no problem. We'll just give it back as a cash dividend. No issue. And so because it's the same, and as I said, the hurdle rate at that point would not be the value of a buyback. It would be a risk-adjusted weighted average cost of capital, because you have to have those two things working, right, to avoid the problem that you're thinking through. So, I think, hopefully we will. I think just the last thing I say on that, as we've looked through some of those papers that were written in the past, I can confidently say that our valuation. I would say this, wouldn't I? But I think that the valuation that we did on the buyback. Let me say this. Yeah, I don't know if this is all right. Anyway, here we go. I would say that this organization, in your language, this organization was a growth investor. And it made decisions with a growth mentality. And today, geez, I'm going to live to regret this, we're a valued investor. We're a deep value investor. Of course, we want growth. But that's how we see the lens. Maybe it helps? I don't know. And I can see that in how we wrote board papers, 2011 versus what we do today. There you go. It's time to stop. When I start saying things like that, it also is out of time, so that's all good. In any event, thank you very much for joining us today. I hope that was very helpful. And obviously, we're going to have lots and lots of opportunities for us to continue. We know, you've seen us. We love this topic. And so be careful what you ask for, because we can bore you rigid for many hours, as we hope to do in a moment. Anyway, with that, thanks very much. And I think that's the end of the webcast. Thanks very much.